Okay, so finally we're going to talk about outsourcing, which means we have to make a decision as to whether we want to make or buy. When we're talking about outsourcing, we're talking about contracting an outside company to produce a product or perform a service. And then offshoring is having work performed overseas, operating your own manufacturing plants, sales, call centers overseas, or outsourcing overseas work to another company. I personally know that there are some accounting firms that are actually contracting with bookkeeping companies that are overseas, and everything is done electronically anyway, so that the accounting firm pays a pretty reasonable fee to these bookkeeping services that are located either in India or in Taiwan. Then the accounting firm bills out those services to its customers. So it does happen. It's probably happened a little bit more than most people know. And if you've made a phone call for support, let's say to AT&T, or I know that in some cases when you're calling Comcast, your cable carrier, you might find that the person who's answering seems to have a bit of an accent. And the accent could be from anywhere, either China, India, Taiwan. But also manufacturers are contracting out to companies that are located outside the United States. Contract manufacturers only make products for other companies. So there are companies out there that do nothing but make products for other companies. When a company is considering outsourcing, there are 4 items that need to be considered. First of all, how do our variable costs per unit compare to the outsourcing cost per unit? What could we do with the freed capacity? And what volume do we need? So we take those 4 things into consideration when we're considering outsourcing. So here's an example of an analysis we might do. Sony is deciding whether to make its own earbuds or outsource production to Shenzhou Electronics. Sony produces 2 million earbuds each period. So we'll look at the cost for Sony. They have direct materials. The direct materials located here, the direct materials times $4 per unit is going to give us a total of $8 million. This is assuming that our production is for 2 million units. Direct labor is at 50 cents per unit. 50 cents times 2 million units gives us 1 million. Variable manufacturing overhead is at $1.50 times 2 million units is $3 million. So our total variable manufacturing costs, if we add up per unit, it comes up to $6, but $6 times the 2 million units comes up with 12 million. From there, we're going to go ahead and add the fixed manufacturing overhead. In total, it's $4 million. So that means our total manufacturing cost is $16 million. Now, if we divide that by the number of units we have, our total cost per unit using absorption costing would be $16 million divided by 2 million units, and we're talking about $8 per unit. So you can see that the difference between the $6 per unit variable cost and the $8 total full absorption cost is about $2, and really the $2 per unit is really the fixed manufacturing overhead element. Shenzhen is willing to provide earbuds for $7 each. Sony's full absorption cost per unit is $8. So it seems like, okay, let's go for it. But then if we look closer, we'll look just at the variable cost, and we look at, that's $6 per unit. Still, we need to take a little bit more in consideration. Sony could save $500,000 in fixed costs each period by outsourcing. So now we have some numbers we can work with. Sony has no other use for the free production capacity, so we're just going to be figuring or focusing on these numbers. Here's the analysis we're going to do. We're going to look at making the earbuds and outsourcing the earbuds. If we make 2 million units times $6 for variable costs, if we outsource, it's $7 times 2 million units. $6 times 2 million is 12 million. That's making it. And then $7 times 2 million is 14 million. That's outsourcing. It appears that making the earbuds is less expensive than outsourcing when we're looking purely at variable costs. But then we add the fixed costs element. The fixed costs include 4 million for the earbuds, but we give up about, I think the example that we read in the previous says we're going to give up 500,000 in fixed costs, so we're going to save that much money. So $3,500,000. We're going to save $500,000. The total cost to produce 2 million units, it's going to cost us $16 million if we make it. It's going to cost us $17,500,000. So to outsource in this example suggests that it's going to cost $1,500,000 more to outsource than it will be to just produce the earbuds. So another alternative way of doing the cost analysis is we'll take the variable cost per unit in outsource. It's at 7. We'll compare that or subtract from that the variable cost per unit to manufacture. So, okay, it's costing us $1 more times the 2 million that we're talking about producing. That gives us a total of $2 million. The fixed cost savings, well, we're looking at the 2 million cost, additional cost. We're going to subtract the savings and still end up with 1.5 of extra costs to outsource. What we're looking at here really suggests that we would be better off if we just make the earbuds ourselves rather than outsourcing. So the decision rule would be on the left side. If the incremental cost of making exceeds the incremental cost of outsourcing, then let's go ahead and outsource. It's costing us more to make it than to outsource it. Let's go with the outsource. However, just like in the previous example that we looked at, if the incremental costs of making are less than the incremental costs of outsourcing, then do not outsource. Go ahead and produce it or make it yourself. Another thing we can look at is determining the acceptable outsourcing price. At what point in time does it make sense for us? Or, for example, if we're going to go shopping around to see if there are companies out there that would like to place bids, well, at what point in time is it going to be acceptable for us to move with outsourcing? What we're talking about is the cost of making the earbuds would equal the cost of outsourcing. And when that occurs, we are indifferent. So if we get a price for outsourcing at the point where it equals the cost of making it, then we at least know where we could go either way. So what we're going to be looking for if we're going to outsource is something less than that. What would be an acceptable outsourcing price? Has to be less than what it costs us to make, right? So we're going to take the variable cost plus the fixed costs. We're going to take the 2 million times the $6 plus the 4 million, which means the total is $16 million. We'll go ahead and try to solve for the unknown variable cost per unit because we know that there's 2 million units and we know that it's going to cost us X amount of dollars. So this is the X. Now let's call it an N because the times looks like an X. So 2 million times N plus $3,500,000. Now that's the fixed costs. We know that our fixed costs, if we make it, is 4 million, but we can save 500,000. So we have to make sure we bring this 3,500,000 over here. If we then try to solve for the unknown variable, let's pretend that's an N here, in here, in here. Once we're here though, we're going to go ahead and try to isolate the N or the unknown variable. We're going to subtract 3,500,000 from this side of the equation, which will eliminate the 3,500,000 on the right side. And then what we do to the right side of the equation, we have to do to the left side as well. So we end up with 12,500,000. So at this point, we have 2 million times the unknown variable is equal to 12,500. We're going to solve for the unknown variable by dividing both sides. We'll divide both sides by 2 million. So if we divided 12,500,000 by 2 million, we're going to get $6.25. The unknown variable, the variable cost per unit, is equal to $6.25. In this case, if an outsourcing company offers to produce our product for us and says they would charge us $6.25, we're almost indifferent. We could either make it ourselves or we could outsource it. So what we're looking for is something better than $6.25 to outsource. In the previous example, we just assumed that we're not going to be able to use the freed capacity. But what if there was something else we could do with that freed capacity by outsourcing production? Let's look at this example here. Assume Sony can lease the freed capacity to another company for $2.5 million per year. We have to look at that as a bonus, as a gain. Not only are we going to be able to outsource our production, but we could potentially make $2.5 million for the period. Let's see what that looks like. Our variable costs are the same, just like we computed before. $12 million for making the earbuds, $14 million for outsourcing. The difference is still $2 million more to outsource. We compared our fixed costs before. This is the same thing we did before. We were saving $500,000, so that reduced our additional costs to $1,500,000. However, we're going to add to the bottom line $2.5 million that we can earn from leasing out our freed capacity. So we're going to add that. Now we're looking at $1 million in savings. $1,500,000. We're going to subtract the $2.5 million. We're going to actually save $1 million by outsourcing it. The lease income will not exist if we make the earbuds. So now we're comparing this number to this number. So now we're comparing this number to this number. And the difference is $1 million. And in parentheses, that means we're saving money. Okay, we can look at what the numbers say, but we certainly have to take into consideration other items, and that's why you have managers running shows instead of accountants. Pure accountants would say, hey, let's run purely with the numbers, but that's not realistic. We have to look at the benefits and the drawbacks of outsourcing. The benefits are going to be, we can concentrate on our core competencies. In other words, if we're really good at doing something, let's just focus on getting better at that. And the core competencies of companies is really what differentiates that company from other companies. What do you do so well that everybody wants your item? I think you could argue that Apple Incorporated, their core competency is innovation. Now they can focus on their innovation rather than their production. Another benefit would be taking advantage of other companies' expertise. Maybe some other companies are better at production than you are. So you ask a production company to produce something and you move forward with whatever you can focus on. You can reduce risk. And when we talk about reducing risk, if you outsource, and there are a number of outsource companies that can meet your demand, then it's not based purely upon your production capabilities. You have some options here, so that reduces the risk. It could be that you could contract out so that you end up with a lower cost, particularly as the example suggests, companies here in the United States often outsource outside the United States because manufacturers outside the United States might be able to do things for a lot less expensive. The drawbacks, one thing you have to be real concerned about is you don't want to contract out your core competency. That's why you're in business. That's what makes you different. So if you contract that out, that puts you in a bad position because what you end up doing is losing control of your competencies. A drawback would be you have less control. Another drawback would employees need to manage overseas relationships. So there might be some cultural differences, some cultural challenges that we'll have. And often when you have outsourcing, you may end up laying off people within your company because they're not needed if you're contracting out. Okay, and so now we're going to look at deciding whether to sell a product as is or process it further. Let's say, for example, you have 5 steps to your production process, but maybe the third process you could actually sell what you have, and you're trying to decide from that third, do we just sell it as is, or do we go for the final production processes to finalize it and then sell it as a finalized product? The question always is how much revenue will we receive if we sell the product as is, meaning before we go to that next step, Or how much revenue will we receive if we sell the product after processing it further? And then how much extra will it cost to process the product further? So those are pretty straightforward questions and might be a little bit obvious as well, but let's go ahead and look at an example here. Bertolli spends $100,000 to process raw olives into 50,000 quarts of basic olive oil. Should Bertolli sell as is or spend more to process the olive oil into gourmet dips and oils? That's pretty interesting. So we need some information to make that decision. We're going to look at the basic olive oil sells for $5 per quart for a total of $250,000. The gourmet dipping oil sells for $7 per quart for a total of $350,000. Bertolli would have to spend 0.75 or 75 cents per quart or another $37,500 to further process the oil. So now we have all the information we need to analyze. So first we'll look at revenues. And the columns we have set up are sell as is or process further. We're going to look at these two and compare them. If we sell as is, $5 times 50,000 quarts. I think that's what our problem gave us, right? We could sell it for $5. Yeah, basic olive oil sells for $5 per quart. So $5 per quart times 50,000 quarts, that's going to generate for us $250,000. If we process further, we can sell it for $7 per quart, and there's 50,000 quarts. Gourmet dipping oil sells for $7 per quart. If we process further, we're going to generate $350,000. And now we'll compare the two. Well, we're actually going to make $100,000 more by processing it further. Now we're going to subtract from that any cost associated with processing it further. Well, if we sell as is, there is no further cost. However, if we process further, we're going to take on an additional $37,500. Now, if we think about it, we're going to take $100,000 more in revenue, but it's going to cost us $37,500 in expenses. I think that's going to be a no-brainer for us. If we sell as is, we'll generate $250,000. If we process further, we're going to generate $312,500. Therefore, it would make much more sense to go ahead and process it further because we're going to make an additional $62,500. Now we're looking at sell as is or process further, the decision rule. On the left side, if the incremental revenue from processing further exceeds extra costs of processing further, boom, we're a go. Let's make it happen. Process it further. If the incremental revenue from processing further is less than extra costs of processing further, can it? Let's not do that. Let's do not process further because we're going to end up losing money. All right, that concludes chapter 8. Hopefully this format that I'm using now is working a little bit better for you.